Hello, I'm John Tinsman, the Director of Procurement for Liqui-Grow, and I'm here today to talk to you guys about interest rates. Obviously, it affects all of our operations when we borrow money, and it affects our bottom line, our P&L. So it's an important time. We know that interest rates are the highest they've been in 25 years. It's affecting all of us, and let's dig into what it's going to look like moving forward and what it looks like today. Interest rates are often affected by the United States federal funds interest rate, and that is the rate the Federal Reserve sets for large financial institutions to lend money to each other overnight. Right now, that rate is 5.4%. So any money that's being borrowed right now is going to be borrowed at percentage points higher than the federal funds rate. So if the federal funds rate is 5.4%, you're probably borrowing money at 8% plus. Now, it's crucial to understand that interest rates lag inflation. So that means when inflation rates go up, you can expect to see a short time later that interest rates will also go up. Now, why do interest rates have to be higher than the inflation rate? Well, a borrower has to be adequately compensated for their risk. So if you lend money to somebody $1, and 1 year later they pay you back $1, but because of inflation that dollar is really only worth 90 cents, well, that lender lost money because they're only getting 90 cents back in real dollar terms after inflation for the dollar they lent out, even though they took the risk to lend the money out to somebody that might not have ended up paying them back. So for the risk that a lender takes, they need to be compensated for it at a rate above the inflation rate, so they actually make real dollars to compensate their risk and keep the lending markets moving. That means when inflation rates go higher, the federal funds rate needs to also go higher to keep the lending market moving. One of the largest drivers of inflation rates is government deficits. And what's a government deficit? It's when they're spending money that they never taxed. And how can a government do that? Well, they print the money instead. So the government's printing money, much as they did during the COVID crisis, for all their stimulus that they passed, and spending it. Now, with all that extra money in the system, it devalues the dollars that are already there. So you can see this chart of the inflation rate here starting in 2020, and as the government is spending money that they didn't tax, you can see the inflation rate goes much higher, all the way up to 9%. As they do not continue that high level of spending, it falls back down to 3% where it is today. Then you can see right next to that the 30-year fixed mortgage average rate, which is often very similar to the rate that growers might pay for their operating lines. You can see that in 2020 that the rate they were paying was around 3%, and it quickly shot up mortgage rates all the way up to 7% where they are today. Now, you can also see that mortgage rate has not fallen yet while inflation's falling, and that's because interest rates are usually lagging inflation. So if inflation stays low or gets even lower than it is now, then we should expect to see interest rates falling in the next year. And many people are starting to say that will be the case. But if the government prints a large amount of money and the inflation rate goes back up, then that wouldn't be the case. That's the future. Nobody can tell you exactly what's going to happen. But at the moment, if things stay like they are today, people are expecting the interest rates to fall and follow the inflation rates. Now, how should a borrower react to high interest rates? Well, borrowing becomes expensive. So you want to limit your borrowing to the best return on investment, which would leave you with the highest benefit. Here is a chart. It shows UAN prepay. So this is considering a farmer that has to pay an 8% interest rate to borrow the money to buy $100,000 UAN. Now, say he's prepaying for the UAN 9 months before he uses it. Well, that interest rate is only 3/4 of the 8%, so he's going to end up having to pay $6,000 of interest. But UAN normally appreciates throughout the year. Manufacturing plants that make their UAN want to keep the markets moving and moving it out of the plant well before April or May when it's going to be applied. So they try to give you discounts the earlier you buy, and that is passed on to the farmer. So here we're estimating that the UAN would appreciate by 20%, and you would have to pay $20,000 more if you bought it in 9 months versus prepaying for it. So here you can clearly see that you would save yourself $14,000 after deducting the interest expense from the UAN savings. So this would be something that would be worth doing. However, you could see the interest rate on a new tractor in this specific example, you would estimate that you'd have repair savings, labor savings, yield benefits, but you'd also have an asset that depreciates and an interest cost rate. And in this scenario here, which is very basic still, you can see that with the higher interest rate, that it doesn't make sense. But if that interest rate would have been 1%, it would have had a beneficial impact. So that would be, in this scenario, a tractor that you wouldn't want to do this year, but the UAN prepay you'd still want to do. So farmers just need to be careful about when they're borrowing and to try to realistically estimate what the future savings or costs are going to be. Now, that's obviously up for error because nobody can tell the future. You could have a tractor that appreciates in value and UAN that depreciates, but usually fertilizer appreciates into the spring season, and usually equipment depreciates. So in this scenario, this would follow historical trends. Now, how should you react to higher interest rates when you have the money in the bank? Well, the first thing is that you should be putting your money in a place where it yields a 5% plus interest rate. A lot of times that means a money market fund. So instead of keeping it in a checking account where you get zero, if you have an extra $100,000 at the end of a year, you'll have $5,000 more than had you just left it in your checking account. And for doing something that is maybe only 10 minutes of work, well, $5,000 for 10 minutes of work sounds like a good deal to me. You should also look at when you're buying things that the savings you think you're going to get by buying early is more than the money market fund. So if you think you'll save, in this scenario, $20,000 by buying UAN early, versus leaving it in a money market where it would gain over 9 months an extra $3,700, then you should certainly do that. But there'll be other scenarios where you think you might not save, you're not saving more than an extra 5%, where it might be okay to delay the purchase even if it means it'll be a couple percent higher, because you'll yield more in a money market fund. And at Twin State, we practice what we preach. Obviously, we have to prepay for a large amount of fertilizer from the suppliers before we go and sell it to farmers. So we try to follow these rules carefully and diligently when we run our business. Now, where are inflation rates headed over the next 10 years? To me, and this is my personal opinion, declining fertility rates suggests declining demand, right? So when you have fewer people, you have less demand, especially when they're the younger generations that are starting their families and buying homes and buying cars, because they spend much more than older retired people. Also, technology increases efficiency. So as tractors get more efficient and you can plant more acres in a small amount of time, and many, many other sectors of society, as things get more efficient, that increases the supply. So you have falling demand, or you have falling demand and increasing supply. And if you know economics, that leads to falling prices. So falling prices are deflation. So that means things are getting cheaper. And that would hold true if the governments don't run large deficits, that we could see a deflationary environment. Well, what does a deflationary environment mean for interest rates? Well, as we remember from previously, interest rates follow the inflation rate. So if you have a negative inflation rate, you could expect interest rates to maybe also be negative or near zero. Here's an example to show you what it means. So in each generation, you have, if everybody only has one kid instead of two, you'll see you'll go from 100 million workers in the first generation to 50 million workers to 25 million to 12 million in the fourth. And eventually you're going to have 12 million people supporting maybe 75 million people that are near retirement or already retired. And so what does that mean? That means you have a lot of people with money in the bank that because they've been saving for retirement or they are retired, and they're lending it out to try to earn money on their money. And then you have very few borrowers. So you have very few borrowers and a lot of lenders. What does that mean? That means that the market needs to, for every borrower, there has to be a lender. And if you have too many borrowers and if you have too few borrowers and too many lenders, then the market needs to punish the people that are lending to reduce the number of lenders and reward the people who are borrowing to increase the number of borrowers. And what does that mean? Well, punishing lenders means giving them a really bad interest rate, which could be zero. And rewarding borrowers also means making them pay nothing for their money. that they're borrowing, and that could mean a 0% interest rate also. So it's the market's natural way to correct an issue that's being caused by demographics. If you look at the fertility rate in Japan, you can see that in 1950, people were having more than 4 kids each. The average person was having a family that had more than 4 children in it. And you can see 30 years later in this chart, 30 to 40 years later in 1990, when all these people are having kids and building houses, that the inflation rate in Japan was 7% for the government bond. Then you can see in 1960 that the birth rate fell to 2. And you can see 30 years after that, in 1990, that the inflation rate in Japan had fallen below 2, right? So basically now we have an equal number of lenders and an equal number of borrowers, and we have an interest rate around 2%. Well, you can see by 2000 that in Japan that the birth rate had fallen to 1.5 or below. And you started to see then, 20 years later, in 2020, that the interest rates that they were charging for borrowers were negative. So you had so few new people in the next generation that there wasn't enough borrowers. And so you had a lot of competition amongst lenders, and that pushed inflation rates and interest rates negative. So to me, Japan is just one generation in front of us. We're seeing low birth rates in the US that are about one generation behind that of Japan. And to me, I think that could create a scenario where we see long-term interest rates near 0 or even negative, as they were in many parts of the world before COVID, before a lot of the money printing happened. Takeaways for the farmer. What should you make of all this? From the data I have seen, prepaying for seed, chemicals, and fertilizer are very financially beneficial to a farmer's operation. Historically, those 9 out of 10 years appreciate in price significantly into the spring season. So the earlier you prepay, usually the larger the benefit. Also, it seems like interest rates may head lower in the next 1 to 3 years, so it could be a good time to delay making large purchases, whether that's buying a large amount of equipment, a large amount of new land, or a new home. Those things might be best to delay so you don't have to refinance something which is costly in a couple years. Thank you for listening today. I'm John Tinsman. If you have any questions, feel free to reach out to the Davenport main office of Liqui-Grow in Twin State, and I'd be happy to answer any questions you have.
Lead Academy.
Liqui-Grow
Excellence
and agronomy
development.